and Yearbook because last year it was in metals, maybe Yearbook was in oil, and the crude oil, energy, I would say. And we will keep doing this, and we urge the industry, especially the academia, to collaborate with us to bring out more research insights into this field, which will help in the future. And once again, thank all the donors who are willing to come and witness this occasion, and also other audience. Grateful to all of you. Thank you.
Thank you, sir. Thank you for the welcome address. And now I request Mr. Vijay Mehta, President, and me to please come forward and deliver the keynote address. Mr. Mehta.
Our Honorable ED, Sevi, Mr. Garg, MD, Mr. Reddy, our friends from the academic world, senior professors were all there. Ladies and gentlemen, first of all, on behalf of MD, as its national president, I would like to express my thanks to NCX for organizing this program in our collaboration. Our chairman of the Commodities Committee at NV, Mr. Kamlesh Shroff, is also here, who coordinated with NCX for this program. Actually, NV was or has been thought about as an association of people who deal in the equity markets. But now our scope has expanded a lot because the same intermediaries who deal in equity are also now having membership of commodity exchanges. Though many of them have it in different names, but broadly it is all the same ownership structure. So I would just, since I have been asked for giving you a keynote address, so I thought that I will just try to take you back into the memory lane. In the year 1985, the first Indian Financial Services delegation went to USA. And I was very, very young and I was a part of it. So it was led by the top dignitaries, including the Deputy Governor of RBI, and practically had all those representatives who are today into the leading firms and the bankers who became later chairmen of different banks and have by now retired also. And there we were taken to Chicago Exchange. And we were surprised to see the exchange itself. And we were really surprised that why these commodity exchanges have not yet come into India. And later on, then my visits to London, we visited London Metal Exchange. And then we realized that this kind, probably not we, but the industry realized and communicated to the government, and government agreed, and how the commodity exchanges were born in India. And I think, if I remember correctly, Multi-Commodity Exchange, MCX, was not only the first one, but also the only one for a very long time. And I was just reading their history, and I realized that this is almost in the month of October, MCX complete 20 years, which is a very long time. In the initial stages, I don't remember MCX doing very big business. But over the time period, now it has caught up. Last year we had a program in the Gift City, which is again another milestone in the same direction, whereby India has opened its door onto the as a person to or as an exchange to deal into in other cases we discover the price. This is something which I think we all have to work together on this, because the price of gold, price of oil, price of all these commodities, they are all discovered, and we are just a player. And to think of it, we are not even a big player. Though our number of brokers or intermediaries are very large, but when you compare them with the world-class players, I think we are not even counted. In fact, I was not aware that there are, not aware at that time when we used to go abroad and see those commodity exchanges, there were hundreds of them. And a number of them were specializing in different commodities, and those who were specializing in different commodities, most of them were producers of that, like Indonesia in palm oil, or like many examples can be given. But over a time period, what has happened is that even those countries which are not the main producers of that particular product, they are also over a time period, because of their trading capabilities and because of the sheer size of their organizations, who are the intermediary organizations, they have become the largest dealers or traders into that particular commodity. Now, I think we have to start looking at commodity exchanges in a little different way. The reason for that is that not only we are the biggest consumers, but the prices of the commodity matter a lot even to the Indian farmer, who actually has been for whom the commodity exchanges were started in principle by the political leadership. But at the end of the day, he is still not that much a beneficiary of this, both because of the knowledge of the computer or knowledge of his the technology at his disposal, and his access to the markets, the trading market. So what has been happening in reality is that commodity like equities in India is becoming a trader's delight. It is not really a reflection of what should have been due to reasons. Now, like, if there is a problem, weather problem, we are affected. If there is a war, we are affected. If there is anything which is related and which affects commodity, and practically everything affects commodity. This is what I have seen. Equity, of course, the companies who are working there are again also working into different segments of the commodity. But commodities per se, because they are from different parts of the world, so anything which is happening in any part of the world is affecting something related to the commodity. And we being one of the top consumers, we get affected with that. And our farmers are still left high and dry. So this is a situation again which we will have to change. And I think with these cumulative changes, probably there will be a time which I foresee that in the next about 5 to 10 years, I am very confident that we will be able to rediscover the commodity platform or the commodity segment. More so because the present political leadership is very keen to go ahead and make India into one of the leading commodities market. So I feel that this could also be done by allowing more exchanges into India, where right now, frankly speaking, MCX is leading the pack, because with its dominant market share, the other players are hardly anything to write home about, including NCDEX and including BSE Commodity Exchange. So we will have to bring exchanges like MCX, at least 10 exchanges in this country, because we grow so many commodities and we use so many commodities that, like MCX over the time period specializes in gold, silver, and now oil and some other areas. But then there are a number of other commodities for which we need specialized exchanges. And I'm sure that the brokers are always forthcoming. And we also have to not only encourage options and futures, but we also have to check on the delivery side. Because a number of times the delivery factor creates a very can create a very serious situation in that particular commodity price. So this is again something which has to be looked into. I think the future of commodity market is quite bright, and it is expected to be further brightened. And I would like to conclude by saying that if not the world, we should start by becoming a market leader in this part of the world. A situation which was held by China in many commodities till some time back. Now when the world is moving away from China, this is a very big opportunity for India. Because today India is looked upon as a world leader. And we are also now number 5 economy of the world, and our difference is very small. I think our GDP is about 3.78 trillion, and the next one in the line, Germany, is 4.07 or something around that. So the gap is very small. And I am sure that in a maximum period of 2 years, or by 2027 or 26 end, we will become number 4 economy in the world. So when we become number 4 economy in the world, it will be almost very difficult to digest that we don't discover prices at all. And when we are the leader and the biggest consumer in this part of the world, which we call Asia or this kind of the whole continent, I think our first endeavor should be to become a market leader here. Let's forget about London, let's forget about Chicago, let's forget about, and we can start dealing in commodities which are used more on this side. Let's say, just to add a little bit of addition to this, we can start discovering prices of masalas. Masalas are very important. All things, because nobody consumes masalas in the world. And all ingredients of that masala, whether it is a clove or it is a elaichi or it is a kind of cardamom, and number of dry fruits also which are grown into this area, like even saffron, let's say, that from here till Iran, I think, I don't remember the percentage, but the maximum saffron is produced in this part of the world. The maximum number of mamra almonds are made in this part of the world. Not those American almonds which are practically not having any health value. So when we start looking into it, we'll find that there is a lot of commodities whose price can be fixed up by us. And once we start becoming a world leader into those, let's say even those small quantities, once we start becoming a world leader in those commodities, slowly our traders will become stronger.
Started at least 15-16 years for certain, various different capacities. Last year, with the year it was the energy handbook. We had an article done, studies for this, for which we've done a conference in Delhi a few years back, obviously pre-COVID. So it's been an interesting journey, and I kind of have seen the market develop. Sir, just one small observation. We actually had a market. The government actively shut down that market in 1951. So it's only in 1990s that the government had to reinvent the wheel to re-establish the market. So we actually went back the whole cycle. In the late 1890s, all the way up to 1930, 1940, we had a very, very successful commodity market, with cotton being one of major trades in this country. This is an active way in 1951, under the FCRA, the forward contract regulation and some all of that, the government actively went and banned all kinds of commodity trade. But it's interesting to see the way, and also it's more of a cheek and tongue-in-cheek remark. MCX also has happened to be the right place at the right time. Because both MCX and NCDEX started roughly around the same time. Yes, MCX was a little earlier, but broadly around the same time. And it's literally a quirk of fate, I would put it, as that MCX chose the non-agri as their primary business model. And NCDEX chose agri as their primary business model. And then 2007 happened. The NCDEX has never recovered from the 2007 crisis, which was not their doing. Because it was a very funny thing that in 2007, because of inflation, the government of India, it was the first time they banned agri-commodity futures trading on the market after having launched the market a few years back. And they launched sugar, they banned sugar, they banned pulses, and I think they banned wheat futures. Urad dal, pulses. Right? And that's an attitude the government has not stopped. Even today, they randomly ban contracts every now and then. You know, I haven't tracked it for the last 6-8 months, but about a year back, they randomly banned contracts with nothing going on. The very funny thing is that after they banned the contracts in 2007, 2008, citing inflation as the source, to justify this, they set up an interesting committee. The committee was headed by Professor Abhijit Sen of JNU, and the whole idea, and this was kind of a stated position, that they set up the committee with Professor Abhijit Sen as the chairperson, who was well known as a left-leaning economist. And the whole rationale was, okay, we'll have such an economist who doesn't believe in markets, and therefore, obviously, we'll have a report which will kind of justify our claims. It had Sharad Yadav also as a member of Parliament, Sharad Yadav also as a member of that committee. And very interestingly, you know, this is what I guess fate is all about. The report that came out actually blamed the government for the entire problem. Because all that they went back and found out, and the report categorically states it's not the markets that has created the problem. It's the lack of delivery and storage units which created the problem. So even today, 15 years down the line, we still don't have enough storage facilities, enough appropriate storage facilities. There was a plan that SCI would build proper godowns within 20 kilometers of every mandi. It still remained a plan on paper. And that's our biggest problem. Our problem is not so much in the demand side, our problem is more on the supply side. We can't manage the supply of commodities that are coming. And that's where MCX kind of, as I said, it's a work of fate or whatever you want to call it, got away because fundamentally they were not in that business at that point in time. They acquired the business subsequently, and obviously they have managed it extremely well, weathered various crises over the years, but I think they've managed the whole show extremely well to kind of take it to where we are. Obviously, commodity markets, as Mr. Reddy, you have said, that will never be as commonplace a market as an equity market. The very nature of the underlying product doesn't allow it to be. But I think we've come a long way from where nobody knew anything about it. Today people are talking about commodity markets. We had debated for a long time, and now finally a year and a half back, we finally launched the commodity options, which could actually go a long way in the agri market to take away the MSP and therefore the revenue burden of the government of India. Because again, there have been committees which have looked at it and suggested that the government can only pay the premium on the options. And that actually can work backwards to take out the MSP, because if you take about a 10-year horizon and we just pay the premium on the option contracts, the government underwrites the premium, you get the insurance company as a third party, a tripartite agreement, you can actually replicate the MSP model at a far lower cost. I mean, in a given year the cost may be high because in a given year the MSP may not be utilized and therefore it might be high. But if you take it over a time series over like 10 years period, you can actually show that the government will actually be a beneficiary. And I'm pretty certain that once the market becomes a little more stable, a little more liquid, that's something that the government will actually actively look at. And I think that's something which even the market should, and in India it's a very bad word to use, but I still lobby the government towards doing it. And lobbying doesn't mean necessarily for personal favors. I mean, lobbying could also be to ensure there's a market development that happens. The only other thing I would request, or I would urge MCX to also do, I know MCX does a lot of these things and I have personally been involved in a few of these. We should also try to popularize commodity markets across the board. And to that extent, I think, as Mr. Reddy was saying, we should also try to kind of use that route to reach out to people. Today, I mean, as we were just chatting, you have a gold contract. I don't even know how to buy that gold. Having been actively, so in some sense, and I consider myself relatively more actively associated with XCX than an average person on the road, I still don't know. So, obviously, nobody would know. So, And similarly, there are other contracts where we can kind of easily go ahead and look at it. And the second thing also is there are hedges that can actually be even created using a lot of other contracts. I don't think even the wealth managers and the advisors are aware of this. I think that's an area, instead of going and reaching out to the last consumer is not probably a major investor in the commodity market, but it's his advisors and that, wealth managers, personal finance advisors, HNI advisors and all, who are probably a better target audience, because that's what they will kind of advise and create products which will then help the market. And that would kind of go to a long way towards delivering and improving the market condition per se, and then make it more broad-based. And I think there is definitely value in that context. With regard to whether we become a price leader, a price maker, I'm sure it's only a matter of time. It's just a matter of time. Because we've come to this position in 20 years. 20 years back, nobody would have thought that we would have a successful commodity market. And even in fact, when the commodity markets were launched, and a number of smaller markets did not succeed, there was always this thing that, commodity markets will die out, it can't survive. I think that the fact that we've survived 20 years and where we've come is testimony to the fact that it's a market to stay. People may like it, people may not like it, but you can't wish it away any longer. So now you better start to live with it. And therefore, becoming a price maker or a price leader, I think it's only a matter of time. The only thing is we need to kind of identify what product we want to be a price leader in. Our real challenge most of the times happens is we try to be leading in everything. So, for example, if you look at the China example, Dalian became famous because of the amount they used to control the copper market. For years, Dalian used to control the entire copper market in the world. And that's what kind of gave them the fame and the power to kind of regulate that market. Subsequently, they diversified into other markets and all of that, but so we need to identify a few markets that would be really important to us and drive the process out there. The others will follow in that sense, but I am absolutely certain that it will kind of happen, and it's only a matter of time that happens. The second and final request I have to say is, while this MCX yearbook is actually a very, very important publication, and I happen to have a fair number of them over the years that I have, thanks to MCX. But I think we should actually make it a little more popular. Also, I know MCX, personally I have been beneficial. Whenever I have needed data or anything, I have always asked them and I have got it. But I think it should be a little more proactive and a little more easily available to a large number of researchers, and then kind of incentivize researchers to kind of come and work on that by reaching out to them and this data is available. It's not always the money that would attract academics to come and work on it. But if we can kind of get those things, because this kind of data is not going to be available in the market easily. And today, any major, from an academic perspective, what's our incentive? To basically get a publication at a top-rated journal. Why? Because that improves our career prospects. Anybody in young academy who wants a promotion needs n number of those publications, and that's where the incentive is. So let's play the game that way. Let's not think it's absolute altruism and everybody wants to do it. And that's where I think if we actively reach out to a larger community and make them aware that this data is available, these are some of the problems that we're looking at. If we go with 10 problems, sir, I'm sure you'll have people at least attempting 5 of them, which is not a bad start to do it. And that's how, by the way, that's exactly what NSE has done. So much so that today NSE has gone to the other end and they can charge people to take their data. Today NSE charges people academics they charge marginally, but only the cost, but otherwise they sell the data for a huge amount of money. I'm sure, I'm not saying you need to monetize it to that extent, but incentivize it to kind of say, okay, look, this data is available, these are some of the problems, these are real problems, and we can help you connect with the relevant stakeholders so that there is outcome which benefits the market as a whole, benefits the individual in that sense. And that's what would be my request and suggestion to MCX going forward. I know, I'm also kind of, not just myself, but in a sense, our director was supposed to be, but he couldn't because of some pre-commitments, and I'm extremely happy to also be a part of, represent IMB in the context that we managed to, or we agreed to, jointly be a partner in this yearbook publication this year. So thanks to MCX for reaching out to IMB, particularly in our Golden Jubilee year. This is a Golden Jubilee year of IMB, and Golden Jubilee celebrations are in about 2 weeks' time. So thank you very much, and thank you.
Thank you, sir. Thank you for that wonderfully riveting speech of yours. And we are actually very privileged and honored to have IMB Board partnered with us for the 2023 edition of the Commodity Insights Yearbook. Thank you, sir. Now may I request Mr. G.P. Garg, Honorable Executive Director, CB, and the Chief Guest of today's event to kindly step forward and deliver the
Mr. P.S. Reddy, MD and CEO at MCX, Shri D. Mehta, President and Professor Basu, Mr. Rishi Nathani, Mr. Kamlesh Shaw, and all the distinguished guests who have come, and my colleagues from SEBI and the colleagues from MCX who have been working to make this World Investor Week successful. So I welcome you all, and thank you so much for inviting me. And I was hearing Professor Basu, one of the leaders in this area who have been guiding our students during the assembly when I was here, and Mr. Mehta also explained well about the commodity market. So I'm not an expert in this area, so I will confine my presentation or my speech about what can be done for the common investors. Actually, my feeling is that if you want to make something really popular in our country, please try to see that how you reach to the common citizen or a common man. Morning I open the newspaper, and when you see that now the Indian investors are not bothering markets, but they are putting their money in SIPs, and every month close to 16,000 plus crore rupees coming to the equity market. It is amazing that when India decides to invest, or they feel that something is good for them, they feel that what is best for them, then no one can stop. And no one is, I remember 2008-10 or 11 to work in this Office of Investor Assistance and Education, and it used to take a lot of time to convince or tell what the mutual fund is all about. And we were not sure whether our message was going across, but I am extremely happy that maybe 10, 12 years down the line, 15 years down the line, now even a common students or someone, a young man who comes out of the college, irrespective of he need not be someone from commerce or someone who understands it well, but वो कहता है ये SIP सही चीज है, तरीका है सेविंग करने का, और हम तो अपना SIP, I saw it actually, someone, an artist from JJ School of Art who had absolutely no knowledge about the entire ecosystem of financial markets. हमने कहा अब आपको सैलरी मिलने लगी तो क्या करोगे? तो उसने मुझे यही बोला कि सर मैं और हमारे दोस्तों ने बताया कि मुझे SIP में के थ्रू इन्वेस्ट करना चाहिए. I was extremely happy. The credit goes to all of you and some of the stalwarts sitting here, like Mr. Mehta, Mr. Shroff actually, and with MCX. I was wondering that when I was here, that when you have products like gold and silver with you, is there some way that you can reach to the common citizens? Professor Basu mentioned about the distribution challenges or about the other things, but I'm very sure that if you first you make something which common citizens or Indians feel that it is meant for, and if you are able to achieve that, because luckily there is you are that part of the exchange which affects the life of everyone. So if you can find some way by which maybe this Diwali or maybe you reach at least some 10,000 households, and I know if NME also takes we have to go to the people that ये सोना खरीदने का नया तरीका है, and I am very sure that we'll be more happy to give gold rather than cash, because the advantage is you are actually giving an investment product. When you are giving to some family members on some important occasion, you are not giving 1 gram of gold or 2 gram of gold. You are actually giving investment which will be worth much more in the issue. So I'll personally see that those who feel that there should be some part of commodity, and we all like to see gold. We all like to see the physical gold we can feel. And so I was talking to Rishiji, and when he mentioned, actually I was also floored by the way he explained to me. So I said कि आप लोगों ने वीडियो तो बहुत खूबसूरत बताया, एक वीडियो उस पर भी बताइए कॉमन आदमी कैसे ये सब कमोडिटी खरीद सकता है या कैसे इसका पार्ट. So I'll encourage and say kindly do something, and you please mark my word, if common citizens, common investor, the lady at home understand the normal sales, then that you feel that you have actually played your role. So I request you some of these things which common people feel that this meant for me, and I can be part of it, and I am doing something which is required for me. It will be very good. So please find out, and you are all best brain, because let me also again admit, when it comes to some of the best investor education program, the best idea comes from MCX. So they always come with something very unique. I don't know who is driving, but they always come with some of the best ideas. जो आज बाकी लोग idea इस साल कर रहे हैं, तो MCX ने last year कर दिया था. So they came with some of the very unique ideas, and those we shared with others, and now they are always the pioneers. So I'll again encourage you. You find, and I'm very sure you will figure out, everyone was mentioning, that we should be the leader in discovering the price. When we are the world's largest consumer, I was just googling and found that India was the largest consumer of gold last year, more than 600-700 tons of gold. So you can imagine that. And I feel that if you take everything together, the quantum will be much more. So please build on our strength and see how much you can reach to the masses. We need to start with the big cities. That could be the way, and that can actually make MCX a household name. This year's World Investor Week we are celebrating, and my sincere thanks to MCX. And the theme is a smart investor doesn't invest on unsolicited investment offers. And I'm extremely glad that probably yours is one of the best piece of work which you have created by way of PVC, or you call it. Having some of the message goes across, and I'm very grateful to you, and we'll be sure that this kind of message should go, so that people know that what is the correct investing, not they fall prey to the wrong advice, or they fall to the whatever they see on the channel. They should actually feel more comfortable visiting SEBI or MCX website to get the right kind of advice. SEBI has taken various policy initiatives in this area. For example, permission to launch multiple contracts in the same community, launch of new products, and we just now discussed things like EGR. And so I'm really sure that while SEBI has been doing, and we have been collectively working on it, please try to see that this commodities market benefit should also go to the common investors. बड़े लोगों के लिए तो आप लोग करते ही हो, those who are big players, but see that what can be done so that small investors also feel that there is something. Extremely glad that we will help out together with IIM Bangalore. We are launching this Commodity Insight Yearbook. Let me admit it here, even the top agriculture colleges in the country don't know how the commodities market works, how you can hedge the prices. So I don't know whether you have to make the efforts to reach to at least to begin with those who are policy makers, who are actually understand this stuff. So top professors in some of the agricultural colleges, you go, they will not be able to explain to you how the commodity derivative works. So please, with the help of this year's theme from your side should be that how we can reach to large number of particularly those who will be the policy makers or decision makers, or who matters in this area. So I will sure that this launch of Yearbook would be imparting education on commodity markets and its ecosystem among all stakeholders. Like Professor Basu mentioned, that there will be more and more research in this area. That you have the primary data. Data is something every academician will travels miles and miles to get that data. If you have something, please see that large number of research papers will come. Last year also I was part of it, and I'm very sure that this year's edition will be something unique, and researchers, academicians, everyone who is in the market will be very much beneficial to it. So host of investor awareness activities have been taken. I request those who are sitting here to make themselves more aware about not just equities or mutual fund, but also about the commodities. My sincere thanks to MCX. They have always been supporting the World Investor Week, and this year also they have planned various commodity derivatives awareness program for FPOs, value chain participants, quiz, crosswords, podcasts, question and answer sessions, telecast on TV on commodity derivatives, media campaign for creative awareness, and many more activities. So I would be requesting MCX make it a year-long affair, not just one investor, but very grateful to you for launching it. And my personal thanks to Mr. Reddy, Rishidi, Madam, and entire team of MCX who have always been supporting our efforts for investor awareness throughout the year. And I wish you everyone very good investing and World Investor Week, and it should be not just 1 week affairs, but we should celebrate around the year, and please create more awareness about the commodities market among the common citizens. Thank you.
Towards investor education in a lucid and entertaining manner.
And this go further. So this looks like a mixed, somewhat positive, not so negative about the regulation itself. But then we try to really see the other attributes. Prices can move up or down depending on the demand supply dynamics. One need to really see, are the other dynamics of the prices really moving around? So, to understand market quality, we know that one measure that we use is volatility, right? If prices world over, it is not that when speculators trade in the market, the volatility can be relatively higher. And if you really switch them off by imposing a cost on them, the market would become more sane. Has the volatility really declined? We try to attack this question in a little bit with greater scientific tempo, because I can really compare volatility can be measured for a variety of commodities, pre-post the ban for both for commodities which are suspended and commodities which are unsuspended. So therefore I can compare, has the volatility difference between the suspended and unsuspended commodities that is actually shrunken, or it is really contracted after it, which is evidence of the fact that now look at it, the market has become more stable. The ban has a stabilizing impact on the markets rather than a destabilizing impact. So to study that, what we have done is we have actually compared volatility in two different ways. One is a simple comparison. In our language, we treat that as not very rigorous, not very scientific, but we do something called a DID, which is called a difference in difference, which is a more scientific estimate of whether the volatility is really changing, improving in a direction which is making the market more calmer. First of all, around 6 months around the ban period, we don't necessarily see that the volatility it's not declining. Rather, it is actually in line with where it was in the first place. So it doesn't really give an impression that everywhere volatility is falling. I'm just showing two commodities, wheat and palm oil. But here is the comparison that we have in the table. Charts are independently there in this link, but I'm not holding it up. What we see here is that in a lot of commodities, we observe that the volatility has rather increased after the fact. Because it's like, if you were to really take a horde of people to a room and blindfold them and tell them that they are riskier, then it becomes harder for people to, then they will become more pesky and they will become more disturbed, right?
Because whereas you had the advantage of the futures market broadcasting you what is likely to happen 3 months from now, 1 month from now, that is no more true. So when you shut down foresight, it is natural that investors will become more agitated, and equivalently the commodity traders in the spot market became more agitated. So what we see is more volatility in the spot market of the bank rather than decline compared to the benchmark commodities which we have set up. We do this in a much more rigorous manner called a DID, in which what we find is, in some ways compared to the domestic benchmark, the volatility has just gone up significantly rather than cooling down. So the impression that we cast away from here is that the market has become more volatile, meaning it is not really able to get the information that it could really get when futures market are working. Because you can really get some heads up of what would be prices in future. So therefore it is actually having a negative impact on the quality of the market, the ban itself. Of course, we also try to compute the correlation of returns. The idea is that extremely efficient market information gets processed instantaneously. Therefore, the price movements will not be, today's price movement will not be linked to tomorrow's price movement. The reason being, if any information that could move price tomorrow, if it can be predicted today, it will be predicted. In markets, tomorrow is today, right? So we are saying what could happen tomorrow should actually happen today. But we don't really find that that on that ground or on that feature there isn't any significant change. So autocorrelation we could say, yeah, gradually, hardly any change. But we looked at another factor. One facet of the market is that extremely efficient markets would mean that related commodities, or let's say you trade a stock, here is stock which is A, which is a voting share, and this is a less voting share, you trade it in two different markets, they should co-move very strongly, right? They should. So therefore, one of the measures that we have derived for market efficiency is called co-integration, which is the idea that, how strongly do they co-move? If silver and gold has actually a ratio in which the prices should be, how much do they depart from each other? If they depart too far, they should come back very quickly, right? That's the idea that we have. So we examined what we call as co-integration of the market. What do we find here? We find that the co-integration has actually declined in the market. The Indian commodity spot prices with the international market, there is a deterioration. There is a deterioration of or a decline of the co-integration within mandis in India. Or rather, the extent which markets used to really be integrated across, that is also been weakening. So when we look at the indicators of market quality, not only that the premise on which we banned them was bad, we also find that the ban actually has a negative adverse impact on the quality of the market. That's what we actually had. And then of course, as a quick question, this did not matter, Yeah, I had a wrong premise to make a decision. The decision was undamaging. And I can really redo that, then everything is fine. But what we find is premise is wrong. There is a damage that we have. Can we really quickly undo that by relaunching the contract? And I don't think in this room, I need to reiterate the fact that you are the people who have gone through the experience and lived it through. In fact, the contracts which have been relaunched, we examine the history of that. We don't really see any immediate quick recovery of the volume to where it was, at the point of time of the suspension itself. In fact, of course, there are very many instances which we have. We look at rubber, potato, associate, China. There were 2 events. What we find is that the volumes are not really getting back to where it was immediately on relaunch. Therefore, all the effort that we have been building to build a share of price discovery in India being a commodity intensive country and expected to be so for many decades, unfortunately we have actually a little bit regressing back when we are shutting down these contracts. And I'm sure that all of you are conscious that when we talk about derivatives, unlike cash market, where you can say that, I stop this, suspend this shares trading today, you can restart it tomorrow. But derivative contracts actually are long cycle contracts.
you need settlement over a long period of time. So therefore, if you have, if this commodity is suspended, you have set your shop elsewhere, it is very difficult to quickly leverage out of that and come here and start the volumes again, right? And at times, a lot of trading is actually cross commodity arbitrage and hedging and things of that kind. Therefore, those who are trading in cross commodities, they will also find it a great loss. Oh yeah, if one commodity is suspended, then it has actually a spillover impact on other commodities as well. So therefore, what we find is that the volumes are not recovering. For example, just say for example, rubber, it only reached a 10% volume, potato roughly half, plastic half. Only China in the first event we found that it is actually reaching something like 80% volume. But we find that the second suspension, I don't know whether I can draw too much out of it. Maybe you can add to that conversation. I thought the biggest worry traders have is that what is the guarantee that if I start to set the shop here and put the effort, it will not be suspended again, right? So after the second suspension, the recovery was actually much slower. In fact, the volumes declined further. So therefore, what we see here is not only that your premise is wrong, decision has a damaging impact. Your ability to correct that also comes with a significant cost. Market doesn't really come back to where it was, when you try to really relaunch it. That's the evidence that we have at this point. So as I mentioned, the volumes are not quickly recovering given the long cycle nature, the investment that you require, the cross commodity trades and so on, etc. So therefore, this seems to have dented the vibrancy of the market, not just as a transitory component, but I would say that it is a very strong, relatively enduring adverse impact on the markets. That is something that all of us have to be really worried about in this room. Therefore, what we did is we actually tried to talk to many of people who are sitting here, but I don't think that necessarily I need to beam it back to you. What we find is that literally everyone, no one said this was a good decision to have made. Everyone had to really quickly fall off the contracts, they had made losses. So therefore, let me not repeat what happened to the ecosystem participants. They were disappointed to really have that happen. Okay? Now, do I have too many prescriptions here about what need to be done in terms of policy? The two things that I feel is that we are barking up the wrong tree. When we presented this in Northclaw, there was someone from SEBI there as well. And we were saying, okay, before you think that speculative volume is actually damaging the spot market and is directing it, let's go back and see if there is a really speculative trading that happens in the market. And we said, okay, what is the real character of a speculative market? Character of a speculative market is autocorrelated returns, high volatility, and then reversal of the prices. And concentrated positions by some traders, and trying to really, jack the prices. SEBI already has, and exchanges already have these surveillance mechanisms in place. And regulators and exchanges are reasonably sure that there is nothing like a speculative trading that is going on to really rig the price and manipulate the prices. So the point is that a lot of action, the fact that already measures are in place to really deal with suspected price manipulation and various standards are being already followed, it is more important to focus the attention to the spot markets. Rather, if speculative trading is not driving the prices, it is being driven by the supply-demand dynamics, right? It is quite genuinely a physical market problem. We need to deal with that. What do we do to deal with improved supply and reduce the supply bottlenecks or deal with consumption if they can, rather than attack the derivative market? This seems to be the wrong solution that we have in mind. So therefore, I think it's important for setting up some serious investigation of whether such a thing is lurking in our background in the futures market before any outright decision is taken to ban it. Despite interacting with whoever is concerned several times, we still do not know what was the backroom work that happened that led to the ban in each of these cases. I must admit that with all humility, that still remains as a sort of chimera for us. And the last point that I have is, if at all it is suspended, there must be some programmatic way by which the contract needs to be brought back. To me, one signal that could be used to really bring the contract back to the market is volatility, right? If volatility is what was damaging the market and that has actually spilled over to spot market and creating price manipulation concerns, then if the volatility is actually back down in the market, that's the point at which the contract should be offered back in the market with the same kind of specification that should be set up. So therefore, there should be if there is an announcement that the contracts are unlikely to be suspended forever, market being a self-fulfilling prophecy, that itself will actually have a calming impact on the market, rather than leaving it open and uncertain for investors. Unfortunately, beyond a point, our own ability to understand what went behind to really that led to the suspension itself is quite suspect. So in a nutshell, what we found is that you are premised on wrong logic, decision has damage, and the ability to recover seems to be quite challenged. Therefore, who benefits out of this in our journey to build a market? It remains as a big question mark. And this is despite the fact that this is not the first time we are doing it, and we keep doing the same thing over and again. Maybe we are getting a vicarious pleasure out of that. Who knows? Yeah. I'll be happy to take some observations, or as I said, I don't really have all the answers. I'm sure that you have more observations to share in this context than otherwise.
I just want to understand, was there a spillover effect on any of the other commodities, especially, for example, when you have oil markets, where you have palm oil, you have soy oil, you ban one and then you could have spillover. So, did your study cover anything from spillover effect of?
We have not directly modeled it. What can we think of in terms of theory? One is that when speculators are actually suffering a damage, if there was a speculative instinct in the other commodities, the loss of capital due to shutdown of contracts in one market could lead to less risk taking and position building elsewhere. So it may have, in that sense, a common impact. But that is all conditional on the assumption that those speculative volume there was a lot of heating up that was going on. We don't have evidence of that. So therefore, we haven't directly modeled what is the spillover impact of the commodities ban on something else. But I can even presume that when traders are increasingly getting this feeling that I've built all this over time, this knowledge and a clientele base, and now started to really get some traction, and suddenly products are being banned. It is very natural that the appetite for trading in the commodities market may, in general, will take a hit if not enduringly, but at least for the time being. That's the sense that one can feel about. I don't know if that feeling is shared by some market members here or not. Yeah.
So basically, see, one point of view was to look at what was the impact on speculative participation. The impact. Okay. So one perspective was to check, what was the impact of commodities getting banned on the speculative side of the participants. But the more important part is to check what was the loss incurred by the hedgers for not having the platform to hedge their physical goods, because for hedgers it is a need, for speculators it is just an instrument.
We don't have a quantitative estimate, but the value chain participants we interacted with, the sense that we have were there to really close some of the contracts abruptly and take a loss on some of them. But it is very hard for us to really make a quantitative estimate. In fact, I think Deva, you would remember that in the terms of reference, they had actually stated that why don't we make a quantitative estimate of what is the loss suffered by the exchanges, traders, and hedgers. But this is where I think maybe as my colleague Professor Basu mentioned, that more the data is with MCX, but academics are actually too far away from that at this point in time. So some way, if a bridge can be created to make access to the data for research, so that one can really have more graphic evidence of what is going on in the market, will be useful. As I said, the NSE model. Right now, I'm actually running 3 different projects with NSE. The arrangement that we have is we can't get the data. The data is in cloud. It is in their server room. We only run our R code there or whatever code that we are running. We can only take out the tables and the whatever else that we are generating, like a graph or whatever, right? We can't take out any data. So therefore, what happens is that completely enslaved the concern that, oh, here is an academic who is actually looking like an academic, but is a trader who is masquerading as someone who want to really set up an algo trade. Such people exploiting the data to damage the integrity of the system, that is very unlikely to happen under such arrangements. So maybe, I don't know what SEBI can do, but it would be useful if commodities markets, entities actually try adopting such a model. It is called NSE data room. I think, I'm sorry, we don't have an estimate, and that's where we stop here. We have one more question.
Professor, in your earlier slide, you have shown that Indian prices pulled off more significantly in comparison to the international market. Was that predominantly because the Indian crop cycle are different than the international, where our supplies were just immediately after the ban, particularly in case of mustard or China?
Yeah, so
that
would be
led to a significant pull of the prices.
It might have contributed because we were helpless actually in doing a good control, because we could only use a basket of other commodities which had actually other seasonalities to deal with. So as I said, the big problem for us to even study a market is when a market is shut down, when it is a dark, what do you do in a dark room? So which is why I can say that this is the best workaround that we have. Therefore, your concern is valid. It is quite possible that when you do price comparisons, they have different seasonalities in terms of where they are triggering the supply and so on. Right? That's a concern. No. Yes. But at least on prices we don't have that. But on the volatility, I can presume that our studies are on this not, but on the volatility comparison.
Because when I see the end tail of your palm oil, internationally it has not dropped so much, India has dropped. It would be a result of reduction in import.
Yeah. Partly it could be driven by that in this case, but in volatility comparison it is not, because there we could actually employ what we call the more rigorous econometric approach. So therefore the unobservables or what we have not measured could be controlled in that case, not the other.
Levies, and then it would be applicable.
Yeah, but I mean, it is too complex to do that, but can be tried, yeah. Yeah. We are running out of time. Okay, thank you for your input.
Mr. Garg was also mentioning about what can a common person do to become part of commodity markets. They can invest in mutual funds. SEBI has also taken many steps towards the participation of institutional investors in commodity markets recently. Not even recently, it has been more than 5 years since we have seen SEBI allowing the institutional participant to take part in the commodity market in India. But somehow we have seen that the participation hasn't come. So, three main objectives of the study. First one, to study the existing regulations with different types of institutional investors participating in the commodity market in India. The second one was to compare the rules globally. What are the rules in, say, other countries compared to what we have in India? The third one is to understand the challenges faced by the institutional participants in India when they are participating in commodities market. Okay, so we did a primary research for that. Fourth and the most important one is to suggest ways of increasing the participation of the institutional investor in the Indian commodity market. Okay, so these can be regulatory suggestions as well as these can be suggestions for the commodity exchanges. So for methodology, first we went to the way of the secondary data. We gathered information about the existing regulations, then we did a literature review of what already has been said about the institutional investors' participation on commodities market. Third, we compare the regulations for the institutional investors to participate on equity, debt, and commodity markets. The fourth one, we took the data of the participation of institutional investors in the Indian commodity market from the website of MCX. The second part of our analysis was through the primary data, where we interviewed various market participants, they are institutional investors, namely fund managers of mutual funds, officials of alternate investment funds, category, and hedge funds. Let us come to the analysis. So this is kind of a correlation between Nifty 50 and the commodity market, the commodity indices. Okay. And we see that the correlation is very low. I-complex base metals is a commodity index for base metals. I-complex bullion is for the bullion, the index for bullion, and I-complex energy is for the energy commodities, energy commodity derivatives. So you can see that we have very low correlation between the equity market and the commodity market. Coming to the literature, this is regarding the commodity market in the USA. So the literature says that a lot of inflow has come from the institutional investor in the commodity market in the USA in last 10 years. See, it has increased, the total investment in the commodity market increased from 15 billion in 2003 to 250 billion in 2009. Okay, which shows that there must be something happening in the commodity markets in the US. And what may be happening? The financialization of the commodity market in the US. The institutional investors must be investing in the USA commodity market. Okay. See, this 2007 paper, they say that the exponential increase in the investment in commodity market was pushed by the institutional investments. Okay. So commodity index traders, they use portfolio diversification. So that they use the commodity market for portfolio diversification. For them, commodities is just like any other product in their portfolio. Okay. So it is not a niche product for them like in India. It's just like any other regular product for them. This is what we should aim for as well. In 2012, there was a study which again said that commodity market is seeing lot of institutional investment and which have helped it to integrate with the other financial markets. Again, so let us see the impact of this institutional investment on the volatility. Okay. So in 2017, a study came up which said that the institutional investment has led to a decrease in the variance of future pricing errors. Okay. But there was another study 4 years later which said the opposite. It said that the financialization of commodities in China, this is regarding China. So even the plays differ. If the plays differ, the results may also differ. So it said that the financialization of commodities in China will increase the volatility spillover between the stock market and the commodity market. So if there is high volatility in the stock market, that will result in high volatility in the commodity markets as well. Okay, let us come to some literature in India and China. So there was a study in 2020. It said that it only talked about the theoretical things. It said that theoretically, the financialization of commodity market, it should lead to increase in the prices of commodities, which is a major fear among the regulator as well. Okay? Whenever SEBI or other regulators, they come up with an explanation of why something should be banned, why any commodity should be banned from the market. They come up with this explanation that it will lead to inflation. Right? Okay. So the study also said that there is a positive correlation between agricultural commodity and the domestic stock market in China. Okay. Again, saying that there is a spillover between the stock market and the commodity market. Okay. Right? There was a study in 2020 which said that decrease in funding liquidity will increase the correlation between commodities and stock market in China. Again, like most of the studies are seeing a strong correlation between commodities and equity, which actually we have not seen in India. So in 2020, there was a study which said that financialization of Chinese commodity market, it is much lesser as compared to other developed nations like the USA, the UK, and the European Union. So they are still aiming for higher participation of institutional investors in Chinese commodity market. And China has also taken multiple steps since 2020 to increase the participation of institutional investors at the commodities market. Same here, it also says that correlation and volatility spillover are peak between commodity market and stock market in China. So these are differing results. Coming to India, we still found a study in India where it mentions that the commodity index falls. When the commodity index falls, the investors move to stock market. So there should have been a relation between the stock market and commodities market. So when the commodity market should fall, the investors should move to the stock market and vice versa. But that is actually not happening. So yeah, this is Goldman Sachs commodity index and this is Morgan Stanley commodity index. It also says that this study, Adams and Gluck 2015, it says that they move together with the stock market. Even if you see the crash of 2007, the crash of 2007-8, the commodity index also fell as the stock markets fell. This is the number of non-commercial long positions taken in futures market since 2000 in the USA. So we see an increasing trend from the investment by the non-commercial players, which means that the institutional investment is increasing in the USA. Okay, yeah. Coming to this graph. So as we just concentrate on commodity derivatives, I'll just tell you what this graph means. It means that the 45% of the investors, they are looking towards investing in commodity markets. On the other hand, there are only 23% of the investment providers which were planning to offer commodities as part of their portfolio in 2021. So the investment providers are actually not able to match the demand of the investors. Okay, so these are the 10 top performing alternate mutual funds other than equity, and we find that out of these 10, 9 have commodities. Okay, now we are coming to the difference between the regulations of equity, debt, and commodities when it comes to different institutional investors. Let us look at the mutual funds. So regarding the investment restrictions, we see that EPCDs of particular group should not exceed 10% of the net asset value of the scheme. So this is very different when it comes to commodities. It looks very different to what we have in equity and debt. Okay, we'll come to why it is different. Regarding the fund managers, as far as commodities are concerned, a dedicated fund manager with the requisite skill and experience in the commodity market is required to run a fund, a mutual fund, which has commodities in it. Okay, this is the AIF Cat 3 again. The AIF Cat 3 can't invest more than 10% of the investable fund in one underlying commodity. Why this is a problem? Because there are very less number of commodities in which institutional investors are allowed to participate. And if we restrict the AIF Cat 3 to invest more than 10% of their investable funds in one commodity market, then they have very less places to go. Then they will have to move to debt and equity. So recently, AIF Cat 3 were also allowed to deal in goods received in delivery against a physical settlement of commodity derivative. This was a positive thing that happened for AIF Cat 3. This is for FPIs, foreign portfolio investors. Again, they were allowed in cash settled non-negligible commodity derivative contracts and their industry. Again, a positive thing. Regarding the investment limit, so they can take a position limit of 20% of the client level position in a particular commodity derivative contract. Same thing, that there are only very few number of commodities where institutional investors can invest, and if we put a position limit of 20% there, then it becomes difficult for the FPIs to participate in the commodity market. I'll just move forward because of the paucity of time. This is result from our secondary data. So about 40% of the total number of open long positions have been taken by institutional investors in crude oil futures. So crude oil futures is the shining star among the commodities when it comes to institutional investment. But same has not been seen in natural gas. In March 2020, DIS occupied 80% of the total open long position in high complex base metals. So a huge participation is coming from institutional investors in base metals, but only index, not in individual metals. So in case of high complex bullion, only 17.5% of the total open long positions were taken by domestic institutional investors. Right? So gold and silver have also seen the participation from domestic institutional investors, but we expect more from these commodities. Regarding the interviews that we had with mutual funds, they told that one problem that they face is requirement of a custodian. So there are very few custodians in the market which can handle these kind of contracts. Marketing support, everyone has that thing that they say that more marketing support should be given to commodities. So SEBI has allowed mutual funds to participate in 50% delivery and 50% cash settled contracts in gold ETFs, which they found to be really good, really helpful. Another thing that they face is that from the investor side, the Chinese commodity market has global acceptance. German market, the investors also participate on the German market, but with the Indian market, they don't have confidence. There is no standalone commodity fund allowed in India. They need more 6-month and 1-year maturity contracts to benefit from cash and carry arbitrage opportunities. Yeah. So what are the pros and cons of standalone commodity contracts? The investor who want to invest only in commodity markets, they can benefit from standalone commodity contracts. But this will reduce the gains from the diversification. Plus, a standalone commodity contract can help become a better hedge against inflation. Regarding air cat fee, so they have a problem that the contract specifications change a lot, because of which they are not able to benefit from the arbitrage opportunity. Plus, the minimum value to be invested by an air cat fee is 1 crore, which is difficult to deploy in commodity. Regarding the FPIs, so FPI are only allowed to invest in crude oil, natural gas and energy index. So they want to invest in more Indian commodities like metals. So even if SEBI opens the metal commodities for FPIs, then also it is difficult to bring participation from FPI because of the same reason, that people are more attracted towards London Metal Exchange. Plus FPIs, when they are investing in India, they also face an exchange rate risk. With the Indian rupee falling against dollar, it becomes less beneficial for them to invest in India. What are suggestions? Similar to gold ETFs, the silver ETF should also be allowed to take 50% exposure to silver derivatives. Holding period for non-agricultural commodities and cotton should be increased to 180 days, which will help the investors to gain from the arbitrage opportunities. The gold and silver ETFs prices should be benchmarked to MCX gold prices instead of LBMA prices. Mutual funds should be permitted to launch ETFs for more commodities than only gold and silver. So gold and silver ETFs investing in ETCDs, they should have more clarity on whether they can invest their surplus in debt market or not. Plus there is last but not the least, the GST, there is a GST problem in the delivery of the contract. So if say delivery of the physical delivery of the commodity is taken say in Maharashtra, they have to pay SGST, for which the input credit can only be taken in Maharashtra. If it is changed to IGST, then the input credit can be compensated at say CGST level, SGST level, as well as at the IGST level. So that will be beneficial for the institutional investors. For EMS services, there should be a permission for pool holding and execution for commodity trading. This is again regarding the GST issue. The PMS fund should be allowed to hold net short positions in commodity market. I know that this is a bit difficult for SEBI to allow, but this will definitely help the institutional investors to participate more in the Indian commodity markets. For AIFs, we should remove the 10% investment restriction in one single commodity. This will again help them to come more towards the commodity market in India. This is coming to the current average limit of 2x times the exposure in commodity derivative market, which is very low. Because historically we have seen that the commodity market is less volatile than the stock market. So a limit of 5x can be applied here. This is regarding the custodians, as there are very less number of custodians which can play an important role in this commodity market. Collateral managers should be allowed, they should be empowered to play a role of a custodian. For FPIs, we have seen that recently that market access was allowed to them, which was a very important step towards their participation on Indian commodities market. This is suggestion for commodity markets. So more 6 month and 1 year maturity contracts should be introduced. which will help again in the arbitrage opportunities. The marketing team can again have a USP, can market the USP of diversification. We have seen that there is very low correlation between the equity market and the commodity markets in India, but still diversification is where we can play around. So India G20 and SCO presidency. This offers a unique opportunity for the exchanges to market commodity market to the FPIs. Yeah. So they should prioritize mutual fund. They should start from mutual fund because this is where most of the people, like most of the investors lie. Well, they can collaborate with other exchanges in China, US and UK to launch more products. Yeah, that's all from my side. Thank you for being patient. I have taken, I think, 5 minutes extra. Sorry for that.
Thank you. Thank you so much, Mr. Mansur. Yeah, if there is any questions, you can take a few questions from the audience.
Or we can even talk that. Yeah, I think you must be waiting for yes.
Is it not too early that we are comparing the global markets and the Indian commodity markets? Number one. Number two, the global commodity markets, if you look at international markets, currencies, forex is the largest, then comes commodities, then comes stocks. But as far as India, domestic markets are concerned, I think stock markets are leading, then forex, and then commodities.
Yes, exactly.
And is it not too early? We are just what? On the online platform or to the normal consumer, we are just a 19-year-old market.
Mm-hmm.
So I just wanted to understand, is it not too early to compare or allow more than 10%, like what you said, if the suggestion of allowing 10% or more, or allowing short positions by the mutual funds? Can our market grasp that short selling?
Okay.
If you compare mutual funds, the kind of funds that the mutual funds are playing, and if you remove the 10% capping, allow short selling, are we capable enough to grasp that short selling?
Yeah, but we have to start somewhere. So
Yeah,
the
but-
10% limit, so we need to understand that institutional investors are allowed to participate in very few commodities, say energy and metals. There is no agri commodity in which the institutional investors are allowed to participate. So the institutional investors are left with very few commodities with that 10% limit. So if we don't allow them to invest more than 10% in a single commodity, then we are actually forcing them to invest, to launch a fund where most of it is just equity and debt and not commodities. Say suppose they want to launch a contract, they want to launch a fund where they want to keep, say, crude oil as a commodity. Okay, but just crude oil as a commodity. So they cannot take more than 10% position in crude oil. They will have to keep 90% of their portfolio as equity and debt. So that poses a problem. Regarding short selling, I know that it may look too early, but this is coming from the demand of the institutional investors. I know I mentioned that it is difficult for SEBI to do that, but it will be beneficial.